This video is a introductory video by Green Penny Trading and Research Company, and it's called the 10 Commandments of Trading. Here at Green Penny Trading we trade mostly commodities, futures as well as Forex, but we focus on futures trading. This is not advice at this stage, but just some general information for the public that is meant to be helpful information on how to trade successfully. If you follow these 10 commandments, you will eliminate a lot of losses, losing money during your trades. And I've discovered these commandments and written them out based on learning the hard way, which is losing money. So number one, the 1 minute rule. 1 minute rule is commandment number one, and it's you aggressively manage your trades. If the trade is not working out within 1 minute, exit. Commandment number two, always use a stop loss. Never, ever, 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 ever trade without a stop loss. Now, let's look at what a stop loss looks like. I'm pulling down what's called the depth of market onto the screen, and this is in NinjaTrader. This is what we use to actually trade, and I'm going to set an example here using the Euro Forex future. I'll explain all this at a later time, but when you place a trade, you want to make sure that if your trade goes against you, you don't lose too much money. So at a certain point, you say, okay, if I'm buying and the price comes down lower than what I bought it for, then at a certain point I don't want to lose too much money. With the Euro Forex currency futures, it's $12.50 per tick. So the price right now today is February 8th, 2012. And it's about 11:30 p.m. California time. The market is about to open in 30 minutes, the London Open, and the price currently is $1.3296. That means for every euro dollar, you will have $1. Now it's $32.95. $1 and about 33 cents. The euro is weakening a little bit, which means the dollar is strengthening. I'm going to place a trade here just to show what a stop loss looks like. I want to use one contract, so I'm going to keep that as 1, not 2. And here's the stop loss. So I'm going to go for 8 ticks with a 6 tick stop loss. So I'm trying to make $100 here before commissions. Commissions are the cost of placing a trade. In this particular simulated program, there's no cost, but usually it's around $5. A good broker will charge you between $5 and $7 per trade. So if I make 8 ticks, 8 times $12.50, that's $100, and minus commissions, that's about $94 that I'll make. My stop loss is 6 ticks. So if I buy, and the price goes down 6 ticks, it's 6 times $12.50 is $75 plus commissions $80, and I say, okay, this is not working out. So let's apply rules 1 and 2 and see what happens. And I'm looking at a chart right now, I'm just illustrating rules 1 and 2. Placing the order. Okay. Orders pending. Orders filled. Now see, here's the stop loss here. I bought. See right here it says buy, and this is my goal. And if the price goes down this far, then it's automatically going to close out. The reason why I use the stop loss, because you never know what's going to happen in the market. Things can go haywire. Some crisis could happen, an earthquake could happen, hurricane someplace, who knows what could happen, and the market goes up and down, and you won't want it to just eat up all your money. So it's gone up one tick. I'm going to pause the video. Well, no, I'm not going to pause the video. I'm just going to wait and see the 1 minute rule. Let's see what happens. While we're waiting on that, I'm going to pull this up and move on to the commandments number 3. Never move a losing stop further negative. So I'm going to pull this back down. So let's say price starts to go down. See, this brown part here is where I entered. This is my stop, and this is my goal. Let's say price started moving against me, and I thought, oh well, it's going to go back up eventually. I'll just move my stop down further, a little further, a little further, a little further, and then price goes down and down and down and down and down. No, that is the wrong thing to do. Never move a losing stop further negative. Do not move a losing buy stop up or a losing sell stop down. Never. Because the key to making money in futures trading is to stop yourself from losing money. It's not just to go in and say, okay, I'm going to make a lot of money. It's to go in and say, I'm not going to lose very much money. So then your options are, you either make a little bit of money, or you make a lot of money, or you lose a little bit, but you are not going to lose a lot. And the key is aggressively managing your trades. Don't always use a stop loss, and don't move a losing stop further negative. Number 4, do not add to losers. So let's say price started moving down a little bit on this trade, and you thought, well, if I add another contract here, see it's moving down. If I add another contract right here, then I'll average out, and I will, I'll be able to instantly go back up, and I'll be able to make more money faster. No, not the thing to do. Do not add to a losing position or average down. This is not the same excuse me, as starting out with multiple lots. Rather, multiple lots I have one lot on. It's not the same as starting with 2 lots or 3 lots or 5 lots or whatever. It's when it's going against you and you start to panic, you think, oh, well, I'll just average down and it'll be like a whole new trade, and I'll just, add another contract here. Next thing you know, you're moving your stop down, and you're going further negative, and you're losing even more money because you added to a losing position. Do not do that. That's commandment number 4. Now, commandment number 5. No news events or overnight holding. Do not hold a position overnight or during an economic news event or calendar announcement. Wait until the pre-market or the market open to trade, and then right after a news event, trade the reaction, because you never know how price is going to react to the news. It could gap up, meaning it just automatically just skips all the way up, or it gaps down, it skips all the way down. If there's a surprise unemployment reports or payroll reports or a FOMC announcement, something big happens, and you don't know what's going to happen. So that's gambling if you're trading during a news event or you're holding overnight. You don't know what's going to happen, so don't trade during those times. Wait until after the market open, and after the news event, look at the reaction and see what happens. Number 6, no selling at support or buying at resistance. Do not sell at levels of support and do not buy at levels of resistance. Now, I use 3 charts. I'm going to pull down a big picture chart here. This is my big picture chart. And it's the 10,000 volume. My stop was filled on, see, I lost $75. But it's okay because price went down even further, and it's looked like it's heading down, and I cut my losses early. It's better to do that than to move my stop down and move my stop down and move my stop down and continue to lose money. Better to just take that small loss and learn the lesson than to lose big money. You don't want to do that. Anyway, back to support and resistance. How do we know what support and resistance is? Well, each of these yellow lines here represents a new day in the market. So, this is the beginning of February 2nd, February 3rd, February 5th, 6th. I don't know why that's looking like that. It must be a weekend. But anyway, oh, I see. So the market closes at about 1 p.m. See, it says 13:59 down here. 13:59, 1 or 2 p.m. California time. It closes, and like the all trading for that particular day, and then there's a break, and then it opens back up again the next day, and then goes through all the way again to the time that it closes. So this is a trading period, a trading day basically. So from about 2 or 3 the day before to a whole 24 hours of trading. So what I do on this big picture chart, this is the 10,000 volume Euro Forex, is I put a little rectangle here at the bottom that shows the 2-day low. So the last 2 days, this is right now, the last 2 days this was the low, which was around 1.3091. And then I put a rectangle up here at the high for the 2-day, 1.3289. So this is 1.3290. So this is major resistance up here and major support down here, the 2-day high and low. And then between there you've got several other points of support and resistance, and I'm going to draw these lines now with blue. And where I draw the lines is at the points of swing highs and swing lows. So let me make this a little thicker. That's a level of support and resistance right there. And I'll copy that. And then this is another level of support and resistance right here. And there are some little ones like right here, swing high, swing low, and a couple more right here. But generally, it's these 4 places: the 2-day high, the 2-day low, big swing high over here. What's a swing high? It's a high point where the high of the candle after it is lower, and the high of the candle before it is lower. So you get another swing high over here. This candle here before was lower, and this candle was lower. But it's so close. This is 1.3166, and this is 1.3171. That this is just the general area of support and resistance. And then over here, you've got another swing low, but it's kind of a double swing low, which is, this candle before it was lower, this candle before it was the same, but then the one after it was higher, so price went down, and then it said, oh, we got to go back up. We got to go back up, and try it again, and we got to go back up, and then try it again, and come back, we got to go back up. Try it again, it broke through, but then it said, no, we got to go back up. It tried one final time, and it said, no, we're going up. So this area right here, this is support and resistance. So you got to be careful when you're approaching those areas, because price is going to react. So this area in here is an unresolved area. Why? Because this swing low has not been touched again. It's been broken through. Price went up to it, and the sellers came in and shoved them down. Then price went back up again. Sellers tried to shove them down, and they broke through and said, no, we're going to keep going. Boom, 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 boom. Broke through. Boom, 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 boom. Sellers came in and shoved it down. They broke through, came up again. Sellers shoved it down. Now, at some point, price has a way of naturally touching what's called fresh areas of support and resistance at the swing highs. So price is going to come down and touch this area. So be careful when you're approaching that area right there, boom, because price is going to naturally recoil from it and want to go back up. So that's on the big picture chart. Support and resistance. You got to be careful when trading in those areas. Now on the strategy chart, sort of a middle chart, there are other areas of support and resistance, and they're called pivot points. And if you use Ninja Trader, you can go up to this little thing here and put pivot points, and it will plot it for you. So on my middle chart, I use pivots, and I plotted that, and I also use 3-day rolling pivots right here, and I click that, and what it does is the pivots button gives me the resistance, first level of support right here, second level of support right here, first level of resistance, second level of resistance, and then the pivot point based on the previous day's trading. And then the 3-day rolling pivots gives me the 3-day high. What was the high for the last 3 days? I'm not seeing what this is saying, but that is also an area of support and resistance. This is the pivot point, and the 3-day pivot point, 3-day directional pivot, the 3-day WAP. So just be careful around these lines. That's the lesson. And this is just a brief overview. I'll have other videos to go over more detail of what I'm talking about. I'm going to put this big picture chart back up. Moving right along to the next commandment. Limit risk to 2% of your capital on any one trade. So pulling up my calculator here, let's say you have a moderately sized account of $10,000. So 2% of that is $200. So that means if you're trading the Euro Forex and it's $12.50 per tick, that's 16 ticks, but you got to figure in commissions. Commissions are like $5 to $7. So just to be safe, take away 1 tick, you've got 15 ticks. So on any one trade, you cannot risk any more than 15 ticks. All that means is your stop loss cannot be greater than 15. 15 times 12.5 is $187. The reason is because if you're trading and you lose 10 times in a row, that's $1,875. Your account can handle that. After a couple of days, you'll be okay. But if you're trading 10% on each trade and you lose 10 times in a row, you've wiped out your entire account. So the odds are that after a while, if you're careful, you will start to make money. But you cannot risk more than 2% at a time. If you risk 5%, 10%, 20%, you're going to be wiped out in no time flat. Number 8, no counter trend trades. There's a lot of people who trade against the trend, but I try to avoid losses as much as possible. And I'm going to bring down my middle chart here, my kind of strategy chart. This is the 1,000 volume Euro Forex currency futures. And the way that I determine the trend is, so I use 3 charts. My big picture chart, my middle strategy chart, and then my entry chart. This is 1,000 volume, my middle chart. My big picture is 10,000 volume, and my entry is 250. I haven't shown the 250 yet, but here's 1,000 volume, the middle chart. This is kind of my universe and what I look at to see where is the trend. How I determine the trend is to look at where price is in relation to the moving averages. There's a lot of people that say they don't use indicators, they don't work, and whatever, but the reason why I use moving averages and some indicators down here, which I'll get to at another point in a video, is because so many people look at them. So even if they lag, the point is that there's a lot of people who are paying attention to them, and you can make money, because they're moving, they're acting, based on indicators and moving averages. I find that they're just generally helpful. I'm all about price action as well, and looking what price is telling me, but the moving averages can help the analysis. So looking at where price is in relation to the moving averages right here tells you where the trend is. If price is above all four, this is the 5 EMA, no, this is the 5 right here, there's a 10, and there's a 20, and there's a 50. So I've got 4, the 5, 10, the 20, and the 50, the moving averages, which I'll get to in another video, and these are exponential moving averages. Price launched up above all four, but see how this 50 EMA was above, these four, and then the more recent ones started to climb up. I wouldn't buy here, even though price was above all four, because the 50 is still above the 20, it's still above the 10, it's still above the 5. It's in a transition phase. But when the younger ones are higher up than the older ones, as is the change that's made right here, boom, that tells you the trend is up. At this point, you're not really sure what's happening with the trend. This is transition. Here, the trend was down. It was below all four. The younger ones were below, the 20 is below the 50, the 10 is below the 20, and the 5 is below the 10. The trend is down. But then it starts to change. This is a range, this is a transition, and then boom. Price flies up above all four, and the younger ones are all above the older ones. That means the trend is up. Now here, right now, the market is beginning to look like it might change. See how this 5 period is getting close to crossing down below the 10? I wouldn't buy at this point because it's just looking like price may want to come down a little bit. It might touch the 50 and come back up. It might touch the 20 and come back up, but I would rather trade when it's just really clear. So that's how you determine the trend. So I wouldn't sell here, I wouldn't buy here. You don't really know. And then the MACD has just crossed down on the ADX. Red is coming up. I don't know. And then the momentum is showing you, the momentum on this board move here is coming down, and momentum is going below zero. That's a bad sign. So I wouldn't buy, I wouldn't sell, I would wait. Now, number 9, no setting and forgetting. Do not set and forget a trade or walk away from money or risk. I mean, you just don't do that. You just can't enter a trade and say, okay, I'm just going to go watch TV and, whatever happens, happens, even if you have a stop loss. Now, you want to actively manage. You want to, because what if price goes up, and hits 9 ticks, and then you're at 10 ticks is your goal, and then it starts to come back down, back down to like 8 or 6 ticks. You might want to just take that off the table and say, okay, I'm done with that, because it didn't quite reach your profit, but you know what? Take that money off the table. Don't let it go down and hit your stop loss. Try not to let a winning trade turn into a losing trade. At least break even, And so when you set and forget and walk away, that is not aggressively managing your trade. So as you can see, these rules are all about preserving your capital, not losing money. Preserving your capital, That's why you have the 1 minute rule. That's why we have the stop loss. That's why you don't move the stop further negative. You don't add to losers. You don't risk gambling with the news events or overnight holding. You don't sell at support or buy at resistance. And you limit your risk. Don't trade against the trend. No setting and forgetting. And finally, the Max K formula. Use this formula for maximum contracts to trade. And this is a formula that I created. Going back down. It's pretty simple. It just helps you to know how many contracts to trade so that You will make a lot of money without losing too much, and it feels comfortable and safe. So the hardest part about trading every day is when you start out with one contract, because it's an effort. If you have six ticks, it's only $75. 8 ticks, it's only $100. But if you trade with 5 contracts, 6 ticks is let's see, 5 times 75 is 375. It feels great, but it's also, you could lose money too. Price goes against you, 6 ticks, that's negative $375. You have to wait until you build up your account. And I like to do it every day. You start out with one contract, then you make a little cushion, and then you start adding contracts. So if the formula is your net profit divided by 250 plus 1, that equals the number of contracts for you to trade. So you don't have any money that you made. If you divide that by 250, that's 0. Plus 1, that means you can only trade one contract. Basically, for every $250 you make, you can trade one contract plus 1. So if you have $250 net, meaning after commissions, you divide that by 250 and then add 1. That means you could trade 2 contracts, so that's $25 a tick. If you have 350, you divide that by 250 plus 1. Well, that's 2.4. You can only trade 2 contracts. You haven't made it up to 3 yet. Once you get to 500, then you divide that by 250 and then add 1. That's 3 contracts you can trade. You got a little cushion. So 3 times 12.5 is 37.5. If you make 6 ticks on that, that's $225. And then you add that to your 500. You get up to 750 divided by 250 plus 1. That's 4 contracts that you can trade. You just got to develop a cushion before adding contracts. And those are the 10 commandments of trading. Thank you very much.